of March. I'm hashtag at home, and in my hashtag free time, I'm going to read my hashtag tax guide book. This is the Tax Guide 2020 edition. While I am going live, this part right here is actually pre-recorded, so yeah, give me a few minutes. I'm gonna go live any second. Well, if you're watching this, I am live, but I'm gonna. Wow, I spilled that all over myself. Here I am. Only 5 minutes late this time. And yes, we are back. I'm back, y'all. And I'm backity back. And I'm back, y'all. And I'm back. And it's tax time. And it's tax time. Hello and welcome to my channel, 40 Entrepreneur Drive. Ooh. Ooh. Welcome to my channel, y'all. Welcome back. It's me, Kenya, and I'm back with another live stream for ya. And I'm going to be picking up where I left off yesterday. I'm going to be on here for about 2 hours today reading the Essential Tax Guide. Now, I was here yesterday with a couple of folks in the live stream, and we were going through some of the articles in the Essential Tax Guide 2020 edition. Maximize your 2019 and 2020 returns. And quick reminder before I forget, if you have not already done so, don't forget to do your census. Today is April 1st. This is due today. Yeah, I haven't even opened it, so that's why I got that up here as a reminder to me. As it says right here, your response is required by law. Your response is required by law. I don't believe in all that mess. But I'm going to make sure that I am being obedient to my legal system and making sure I complete my census. So if you have not done so already, this is your reminder. If you don't send this in, they will be coming to knock on your door, knock, 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 and doing that survey to take stock of all who are in the land so they can make the appropriate calculations for different programs and funding and things like that. So let's see. Oh, I forgot to share this out. I could have shared this out. Give me a second. I'll be right back. Hello, everybody. How are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm hashtag at home, and in my hashtag free time, I'm going to read my hashtag tax guide book. This is the Tax Guide 2020 edition. While I am going live, this part right here is actually pre-recorded, so yeah, give me a few minutes. I'm going to go live any second. Well, if you're watching this, I am live, but I'm going to come on here and start reading any second. And so while I'm waiting for folks to come into the live stream, please feel free to mingle amongst yourselves. Share out the live stream if you're able to do it on like Facebook or Twitter, something like that. Let's see, like the video and just give me a few minutes. I'm just doing some last minute things before I come on here. I'll probably be reading about an hour or two. And so yeah, get yourself a refreshment and something to snack on. Get your notebook. Get your pen and paper, and if you got any questions, hopefully I can find the answers in here. I am not giving legal advice. I am only literally reading the Essential Tax Guide 2020 edition. Tomorrow's April 1st, and so tax season is right around the corner. Hopefully I can help some of you guys out who made that thumbs up. Please consider subscribing if you haven't already, and I will be right back to read the Bible. No, that's in the morning. I read the Bible in the morning. Right now, I'll be right in New York. Antibiotic cures are working, so be patient. Soon the storm will be over. We can go back to normal lives. Good to know. Brian Ferris also says, I'll be back. And Bucky's 2.0, yippee! Yippee, yippee, yippee. All right. Put my phone on silent. And yeah. All right. So I don't have anybody in the room right now that is requesting anything. So I'm just going to go back over my table of contents that I went through yesterday. As you can see, there are a few check marks where I already read some articles. These were read yesterday. So if you're interested in hearing about what is the progressive tax code, how to know what's taxable, about retirement savings and taxes, how to save for retirement, and top states for tax-friendly retirement, you want to go to the first part of this video, the live stream. It's only about 2 hours long. If you're on a commute somewhere, or if you're doing some housekeeping, or if you just want to sit back and listen, that is a 2-hour listen. That is a live stream replay that you'll have access to, and I am reading those portions of this tax guide magazine, and I tried to be as helpful as I could. If you look over to the live chat over there, you should be able to see headings. I tried to put headings every time I changed the subject or went to a different article. So if you look at those timestamps, look at the timing next to it, you should be able to find exactly where to go in the live stream. That way you don't have to listen to the entire live stream. I would hope that you would support the channel by listening to the entire live stream, but if you're short on time, or if you're only interested in a particular part, look over at the live chat replay, look at the headings where I have it broke down, different parts that I'm talking about, and you can go straight to that part. And I'm going to try my very best to do the same thing here. And so let me go through the table of contents. These are the items that I have not read today. In section 1, the only thing that I didn't read is understanding tax credits and deductions. Section 2 is talking about the lasting effects of the TCJA, and I don't remember what that means, even though I just learned it today. I think it was the, TCJA. I think that means tax cuts and jobs, something or other. I don't remember exactly. But anytime I come across an unfamiliar term or an acronym, I'm going to put it in the description, or not in the description, in the live chat, so that everybody's on the same page and we all have an understanding of what I read when I go through this magazine. Tax Cuts and Jobs Act. Yes, that's what it means. Tax Cuts and Job Act. Tax Cuts and Job Act. Okay. So let's see. Section 2 was talking about the lasting effects of the TCJA, which is the Tax Cuts and Jobs Act. Let's see what else. Other important changes you might want to know about. Pay attention to these small changes. Should you file your own taxes or hire a professional? Keeping your tax documents organized. Getting organized. Should you use print? Should you use digital? Types of income and how they're taxed. Income tax forms and how to read them. Choosing your filing status. Top 7 questions about tax deductions. Common deductions and credits. Lowering the chances of an audit. All about extensions. Hitting the tax withholding sweet spot. Your new W-4, the tax incentives of home ownership, rewards for do-gooders, understanding taxes on your investments, is HSA right for you? And I believe, if I do remember, HSA is Health Savings Account. Yeah, I do remember that one. So is an HSA right for you? Estate taxes and passing money to your heirs. What is estimated tax? What does that mean? And who pays it? Beware of tax scams. The state of state taxes. How to minimize taxes if you live in a high tax state. New for 2020. Update your W-4 after a life change. So if anybody watched me yesterday, I put out a very short video about a life change that is happening, not my life per se, but in my son's life. So as of yesterday, my son is now a husband. He now has a wife. That is a life change that would pertain to taxes. He also has a child on the way. That is another life change that pertains to taxes. So those types of things you want to be aware of. Maybe filing differently if you do have those types of life changes. What else do we have? Oh, that was talking about updating your W-4s after a life change. There's also get strategic about bunching deductions, keeping up with quarterly taxes, plan your capital gains and losses, organize records as they hit your box, take advantage of special tax provisions, what you need to file your taxes, tax form checklist, tax contacts. Your marginal tax bracket is home office expenses, business expense tracker, charitable giving, medical cost tracker, what's eligible for an HSA, important tax dates throughout the year, 2020 tax planning, and track your 2020 freelance income. So if any of those sound like something that you guys might want me to start with, let me know. I will start with one of those particular articles. Other than that, I'll probably just move from front to back. Life of Key is in the room and says you are buffering. Oh no, I shouldn't be. I'm looking at myself. I have excellent condition. I have excellent connection. Okay, you said you're good and hello. Welcome back. Guess what? It's time for Tax Magazine reading time again. I do appreciate you coming in. Don't forget to hit the thumbs up button if you haven't already. And yes, is there anything from what I read from the table of contents or anything on your mind that you may have questions about as far as filing taxes or learning something new about taxes? Let me know before I get started. Otherwise, I'm going to probably start from the beginning of the table of contents here. I'm probably going to finish this last section talking about understanding tax credits and deductions, and then I'll just go on to the next section. Maybe I'll hit like one point, like the first thing in each section. Other than that, unless you guys have something specific that you want to have covered. And while I'm waiting for that answer, I am going to start reading this first little section that I ended up on yesterday, just so I can finish this box. Yesterday I read what is a progressive tax code. I read about how to know what's taxable, and I'm going to now just finish up this section, understanding tax credits and deductions. So yes, thank you for coming in. Share out the live stream if you have a chance. Thumbs up, and feel free to talk amongst yourselves while I read. All right, this is talking about understanding tax credits and deductions. This is on page 11. And let me show the cover. If anybody is willing and able to get out right now, you can purchase this magazine. This magazine is still current until the end of this week, April 6th. So this is what it looks like, the Essential Tax Guide 2020 edition. And as you can see right here, it says this will be on display until April 6th. If you want to get your own copy. How do you understand tax credits? Let's find out together. Understanding tax credits and deductions. When filing your taxes, you'll want to take advantage of all the tax credits and deductions available to you. This can help reduce your tax bill significantly. However, it's important to understand the difference between credits and deductions. Do you know the difference between credits and deductions? One difference is that credits provide a dollar-for-dollar reduction of your taxes, while deductions provide an indirect tax reduction by lowering your taxable income, thus reducing your total tax bill. There is a wide variety of credits and deductions available, though which ones you qualify will depend on your circumstances. So I'm going to take some time to write that into the chat. So if anybody comes back for the replay, they can know that I'm talking about understanding tax credits versus deductions. All right, so there's a timestamp on this right now. It says 9:21 a.m. But if you watch this on the replay, the actual timing of the video is going to pop up there, which is going to be like 16 minutes and 30 seconds. That's what it shows for me. Okay, let's see. Tax credits. Tax credits directly, now we're talking about the credits, getting credit for something. Tax credits directly reduce the amount you owe. So a $500 credit means you pay $500 less in taxes. Credits are typically offered to help offset certain expenses, including buying a first home, child care costs, adopting a child, caring for elderly parents, or energy efficient projects, such as installing solar panels. Business owners can also take advantage of tax credits. I think if you buy a refrigerator, certain appliances, big appliances, and they'll have that Energy Star on there, you pay more for it up front, but because it is going to be lowering the amount of electricity that you use, they give you credit for those types of purchases. Tax credits are less common than tax deductions. They are worth varying amounts, and whether or not you qualify will be based on factors such as filing status, age, employment, and education. There are two main types of tax credits which operate in different ways. You got your refundable tax credits, which are the most versatile credits that you will encounter. They are subtracted in full from the amount of taxes that you owe after deductions, and they can be used to increase your refund. These credits offer the unique ability to reduce your tax liability to less than zero. So let's say you owe $500 in taxes and you're eligible for a refundable credit of $800. That means your tax liability will be reduced to negative $300, meaning the IRS will give you a $300 refund. Some of the most common refundable credits include the additional child tax credit, earned income tax credit, and health coverage tax credit. This is the other one here. Non-refundable tax credits reduce the amount of your income tax up to the amount of income tax you owe. It says here a non-refundable credit cannot reduce your tax liability below zero. So you're not going to get a refund from this part. Non-refundable credits expire in the year that you claim them and cannot be carried over to the next year. Common examples include the adoption tax credit, the child tax credit, the foreign tax credit, and the mortgage interest tax credit. Here's a pro tip. Be sure to use all the deductions and credits you're entitled to, and keep all your documentation to back them up. Hello, yes, and tax. Understanding tax deductions. Now we're talking about the deductions. We just covered the credits. Now we're going to talk about tax deductions. Tax deductions reduce your income tax bill indirectly by lowering your taxable income. The amount you receive in tax deductions is dependent on your marginal tax rate. So yesterday we talked about those tax brackets and the marginal tax rate from that last bit on the top, also known as your tax bracket. For example, if you are in the 24% bracket, then a $1,000 deduction will reduce your taxes by $240, or $24 for every $1,000. There are two types of deductions: the standard deduction, and the itemized deductions. As a taxpayer, it is best to use whichever amount is greater. Standard deduction. This is the definition of the standard deductions. Let's see. Standard versus itemized. Most people take the standard deduction. The amount you can claim is based upon your filing status, and that amount is adjusted for inflation. So we've got single, married filing jointly, and surviving spouse, married filing separately, and head of household. Those are the different filing statuses. Most people take the standard deduction. The amount you can claim is based upon your filing status, and that amount is adjusted for inflation each year. See the table below for figures. And so let me do a close up so you guys can see the chart. It says here, oops, is that the right one? That is not the right one. I'm not going to be able to see this very much. So if you look at the screen, this is so much easier to do when I got the screen share. So as you can see here from the standard deductions, we have for a person filing single, a person that is filing single can take a standard deduction of $12,200. For a person filing married and jointly and surviving spouses, you can take a standard deduction of $24,400. For a person married filing married but separately, you can take the standard deduction of $12,200. And for a person filing head of household, you can take the standard deduction of $18,350. So that's the breakdown on that chart there. Now let's talk about some itemized deductions. 16 Candy, welcome, welcome. This is definitely good information to know. Thank you, 40, for sharing with us. Thank you. I'm glad that you find it helpful. And welcome to the Tax Magazine reading live stream. Yes, we're talking about tax credits versus tax deductions. There's a difference. One, you can take away from how much you owe, and the other one, you can give yourself credit, which by the time it's all done and the calculations are made, adds to your refund possibly. Itemized deductions. That's you may choose to itemize if the total of all your deductions is greater than the standard deductions. So I just gave you a breakdown of those standard deductions, but maybe you got a lot going on where it's like, man, I could probably take a lot more off if I itemized every little thing. So let's talk about that. You can only deduct expenses determined by the IRS, which include some medical expenses, some state and local taxes, mortgage interest, investment expenses, charitable contributions, which I think is like the easiest thing for anybody to do, and some job-related equipment. You'll need documentation for all of these deductions. So when you're doing your spring cleaning this year, a lot of people like to donate things and they just drop it off at whatever donation center that they have. Take that opportunity to turn it in to a person that can give you a slip. It's like a tax slip. The Goodwill does it. The Salvation Army does it. I don't know what other churches or organizations you might have in your local area, but a lot of times they will offer you a slip and they use the honor system. Once they give you the slip, you are to fill out what you think is valuable on there. And of course, the IRS is going to make their own calculations. But if you are cleaning out your entire garage, like I had with my eBay inventory, I itemized all of that. I had everything separated out. I knew that I had a bag of women's clothing. I knew that I had a bag of men's shirts. I knew that I had a bag of shoes. I knew that I had a bag of whatever. So I could itemize on there. And there's different websites that you can go to and look at the current market value. I can't remember any right now, but if I get a chance, I'll put that in the description. And matter of fact, I'll look it up right now. And that will give you an accurate amount of how much the things that you're donating is worth. You put that on there, and that is going to go on your itemized deductions. Let me look that up real quick, because I've used this before. How much are my donations worth? And as soon as it comes up, I'm going to remember what it's called. I just can't remember it right now. How about this? Donations value calculator. Charitable donations value calculator. It looks like there's quite a few. I'm going to go with the one from Bankrate. Bankrate.com. I don't know if this is the one that I've used before. Okay, this is a pretty decent one. It's just going to be a chart. So I'm actually going to put this in the description right now while my mind is on it. Follow this link to calculate your charitable donations value. Save that. This is an example of a charitable donations value calculator. And if you use this link right now, it should open up a separate tab for you. That way you can still stay in the live stream but have access to it. But yes, that's just one example of how you can put a value to the items that you are donating, so that later on you may be able to use that to your advantage. Instead of using that standard credit deduction, you can use your itemized deduction. Let's see, where did I leave off? Let's talk about the impact of deductions and credits. What is the impact of deductions and credits? It says here, various tax credits and deductions can affect your tax bill in different ways. The following table illustrates the impact of deductions and credits of the same value for 4 different taxpayers. So we got 4 different people here we're going to compare. See the running numbers table below for more information. The taxpayer with a 0% tax rate has no taxable income, so they can only take advantage of a refundable tax credit. And only if they have earned income. Let me read that again. That didn't really make sense to me. The taxpayer with a 0% tax rate has no taxable income, so they can only take advantage of a refundable tax credit, and only if they have earned income. Their taxable income could have been reduced to 0 by tax deductions. Because they are paying no taxes, non-refundable credits and tax deductions can't reduce their tax bill. Okay, this is the second person. A taxpayer in the 10% tax bracket could take advantage of the full refundable credit, but only a portion of the non-refundable credit. That credit cannot reduce their income tax to below 0. The maximum income tax someone in the 10% bracket will pay is $952. So the $1,000 non-refundable credit can only reduce taxes by that amount. The deduction for someone in the 10% bracket is worth $100, or 10% of $1,000. Filers in the 24 and 35% brackets can take full advantage of both credits and will get a deduction of $240 and $350 respectively based on their bracket. Before taking any tax credits or deductions, check IRS rules to make sure you qualify. And now I will show you this chart so that hopefully that will clarify some things here. This is really hard to see backwards. So this is the running the numbers chart. You can see the different 7 tax brackets broken down here. We have single filers, tax rates, the 0% tax bracket, the 10% tax bracket, the 12% tax bracket, the 22% tax bracket, the 24% tax bracket, the 32% tax bracket, the 35% tax bracket, and the 37% tax bracket. On the second row, you see, for example, the value of $1,000 refundable credit. In the second row, or in the second column, you will see the value of a $1,000 non-refundable credit. And in the third column, you will see the value of a $1,000 deduction. So that completes that section. Any other questions that might either pertain to that article or something else that you might have heard from the table of contents? I think now I'm going to go on to the getting started section. How many people file their own taxes? I do. I think I've only paid for someone in the last 10 or 15 years. I have filed my own taxes. I use the 1040E or the 1040EZ or something like that. Only in the last 2 years, I have actually paid somebody to do it, because since I have my small businesses registered, there's a little bit extra to do with it. A little bit extra. It's not complicated, but I wanted to make sure that it was done properly the right way. There's a few extra forms, and I'm still filing my own personal taxes, but you have to file your business taxes along with it. So there's 2 different things, and I wanted to make sure it was done properly. So yes, this year I might attempt to do it myself. I don't really know yet, but yes, I have definitely filed my taxes in the past, both with the old-fashioned paper one and also with software like TurboTax and H&R Block. They've got one that you can use, but mostly I've used TurboTax. So, file your own taxes or hire a professional is coming up next. Page 25. Let's get started. An overwhelming task. Fortunately, there are ways to make the process a little bit easier. Before you begin, consider whether you'd benefit from hiring a tax preparer or filing your return yourself using tax software. Hiring a pro. First, the bad news. Hiring a tax preparer doesn't mean you're totally off the hook for organizing your taxes. To prepare your return, the person you hire will need information and documents that only you can provide. Even so, using a pro will reduce the amount of time you spend doing your taxes and help ensure that your return is accurate. What is a tax preparer and what is a CPA? Life of Key asks, do you think you can get fined if you do your taxes wrong? Absolutely. Absolutely. I don't know if it is a robot that calculates it or a human that calculates it, but I have in the past had my taxes come back and they said something isn't accurate. You claim this when it was actually this. And it was only off by a little bit, but since I owed, let's say I owed $50, but I put that I only owed $45, they, of course, gave me the difference of that and they fined me for inaccurately putting that on there. So yes, you can get a fine for that. Which is why when you go to a professional tax preparer, they will sometimes say, sometimes it's included and sometimes you have to pay for it, but there's like a guarantee. When you go to a professional, they have a guarantee up to a certain amount of dollars, like, we are going to do this properly, don't worry about it, you're going to be covered, and there'll be like a little guarantee on there. Yeah, you can get fined. Let's see, CPA versus tax preparer. Boy, oh boy, lately some of these words have been giving me quite the vocal exercise. So what is the difference between a tax preparer versus a CPA? Tax preparers are trained specifically to help you prepare your income tax returns. Meanwhile, a certified public accountant, that's what that CPA is, certified public accountant who must pass a certificate exam, and have a background in accounting and finance, typically has expertise in a wide range of accounting skills, from performing audits to preparing financial statements for businesses and individuals. When you need a pro. Now, let me make a little bit of commentary here. So, let me see. Laverne Dorsey says, so there is no goof-proof filing? Well, a really good calculator and proofreading your stuff, pretty much. And then if you use some of the software like Intuit or TurboTax or some of the other ones, they have built-in calculators that help you, but it always falls back on you, because if you're putting in the wrong information, it's only going to calculate what you put in. Good question. There are no goof-proof filing. The goof-proof filing is having a professional do it, because if it's wrong, it falls on them. Yeah. Let's see. Okay, so I was going to make a commentary. Tax preparers versus CPAs. Now, I don't know what state that you live in, but here in the state of Texas, we have a franchise company called Liberty Tax. Liberty Tax, every year, they have somebody standing out in the corner in a Statue of Liberty outfit, and they're kind of waving down cars and trying to get people to come in, and it is a very affordable way to get your taxes done. I don't think those are CPAs. I'm pretty sure those are tax preparers. As a matter of fact, several months before you start seeing that person on the street trying to wave you down to come get your taxes done, several months before, you will see a different type of advertisement up. It will say, come earn some money, learn how to prepare taxes, we will train you. There's no way that you can get trained in a short amount of time to be a CPA. CPAs go to college, university. They're studying for years and years to take a certification exam. So that's something to be aware of. Not saying that there's anything wrong with a tax preparer, but that is the difference. So let me read that part over again just for some understanding. A tax preparer, they are trained specifically to help you prepare income tax returns. Meanwhile, a certified public accountant who must pass a certification exam and have a background in accounting and finance typically has expertise in a wide range of accounting skills, from performing audits to preparing financial statements for businesses and individuals. So when do you need a pro? Hiring a pro can be particularly helpful if you have a complicated financial situation, like you own multiple properties, you have a lot of investment activity, you run a business, or you work as a freelance writer or freelancer, or you have a high income and are looking for ways to reduce your tax bill. So CPAs are typically known, they know the tax system front to back, and they're required to take continuing professional education courses to stay up to date on the latest tax codes and regulations. Furthermore, they use sophisticated software that reduces the chance of human error to affect the accuracy of your return. If you've hired an accountant and the IRS determines there is a mistake on your tax return, depending on the situation, some of the liability may fall on your accountant. Developing a long-term relationship with a CPA who understands your family's finances can also be an asset in terms of planning for the future. Accountants can assist with financial and estate planning as well as provide expert advice that can lower your ability. Speaking of advice, I am not here to give any experiences. So my experience talking about the CPA, which I'm sure as you can imagine is the more expensive route, when you get your taxes prepared by a professional, you can deduct those expenses, the amount that you're paying on the next year's taxes. Or at least I can as a business owner. As a business owner, getting my taxes prepared by a professional is a business expense. Yes, it's almost $300, but I would be deducting, remember we just learned about deductions? I will be deducting that business expense for 2021, the next filing time. So that's something to keep in mind. What does it cost? 10 people in the room, 10 likes. You guys are awesome. I appreciate you. I really, really do. That makes YouTube know that something good is going on at 40 Entrepreneur Drive. What does it cost? It says here, for some, the cost of hiring an accountant is a small price to pay for the amount of money you can save in the long run. Also time. As of 2017, the average cost of hiring a professional accountant for an itemized Form 1040 with a Schedule A and a state tax return was $273. Like I said, I paid a little bit more than $300 last year because I was doing my personal taxes plus my business income taxes. According to the National Society of Accountants, $273 is the average. Here's a pro tip for you. Find a preparer who holds professional credentials recognized by the IRS. And then there's a little website here, recognized by the IRS at irs.treasury.gov. So let me write this in the chat box in case you're interested. And you can always come. This will not be an edited live chat, so you can always come back after the fact, check out the live chat, and look at what's being wrote. Look at the timestamp, and then you can go back and see what was said, and then you can also have access to these links. So here's a link here that they're sharing. irs.treasury.gov.rpo. I don't think that worked. Let me do it this way. www.irs.treasury.gov/RPO. I'm not sure why that link is not working. irs.treasury.gov/RPO. I don't know why that wasn't working. All right, so what I'm going to do is I'm going to copy and paste because there's a little bit extra on the end that the magazine didn't say. And so maybe that will help you guys out because I want you guys to be able to have some resources here to go back to so you can look up your own. There we go. So that is an active link right there. You guys can use it now, and it should open up a separate tab where you can come back to this live chat replay later, and you should be able to use that. That link says here, and I will write it in here. This link, the link above, will give you a, oops, I'll put it this way. The link above is a resource to find a tax preparer who holds a professional credentials recognized by the IRS. Okay, so if you want to come back to this later, check that out. That says the link above is a resource to find a tax preparer who holds a professional credential recognized by the IRS per this magazine here. All right. Any questions? Any comments? Any experiences that you want to share? And for anybody who does do their own taxes, have you ever had any issues? The two issues that I've had, they weren't major. I mean, I had to pay the extra balance. I don't think they've ever come back and said, "Hey, you made a mistake. We owe you more money." But they definitely do it the other way around. So yeah, you owe us a little bit more than you say you did. But you got to be careful too, because you do that too often, and that is a red flag for getting audited, because it makes them think that you are trying to intentionally dodge out of paying what you owe. Let's see what's in the next section here. How about talking about withholding? Who wants to learn about withholdings? Withholdings, I do. Hitting the tax withholding sweet spot. I think I'm going to read that part next. We're going on 48 minutes. I've got about an hour and 12 more minutes to read. And then I'm going to let you guys go. If you need to go, come on back. Make sure you look at the live chat to pick up where we left off, so that you will get whatever information that you need. Right. Hitting the tax. And now, hitting the tax withholding sweet spot. Okay. For many taxpayers, their employers withhold a portion of each paycheck, and they send that money to the IRS. Did you know that? And we're not talking about the, maybe we are. We're talking about FICA. Hold on. All right. Make sure you can see. Trying to give you a visual. For many taxpayers, their employers withhold a portion of each paycheck and send the money to the IRS. Your withholding rate determines the amount withheld. If your taxes aren't being withheld, for example, you're self-employed, you need to pay estimated taxes throughout the year. It's important to set your withholding rate so it covers your full tax liability for the year. If you withhold too little, and you will owe taxes at the end of the year. If you withhold too much, you will get a tax refund. That extra cash sounds nice in theory, but it means that you have given Uncle Sam a no interest loan. Now let me read that again, because some people love the fact that they get tax refunds. When you get a tax refund, you are not getting money back. You're not getting a refund. You're getting money that you should have never paid. It's not a gift. It's not a prize. It's not a reward. It's not something that you've earned like just for being a good citizen. When you get a refund, it's because you overpaid. And whatever amount that you get back, you could have been using somewhere else along the way throughout the year. You could have been investing it and got who knows how much more back. You could have been taking care of your bills, taking care of yourself, doing other things. So keep that in mind. It's really not a refund per se. It's not a gift. They're literally giving you back what you should have never given. So let me start that over now that I've established that. It's important to set your withholding rate so that it covers your full tax liability for the year. If you withhold too little, you will owe taxes at the end of the year. If you withhold too much, you will get a refund. And that extra cash sounds nice in theory, but it just means that you gave Uncle Sam, you have just given the government free money that they can do anything with, and then they'll give back to you. Now, what they mean by no interest loan, if you take a loan out to the bank, you take out $100, right? The bank is going to give you $100. You're going to have to pay back $108 or whatever the tax might be. Well, more like $120 because most loans are 20% ish, right? You go to the bank, you take out $100 loan, they're going to charge you interest. You're going to have to pay back $120, right? When you don't have your withholding right, you are essentially giving Uncle Sam, you're giving the government extra money. They're not paying interest on that. Let's say you overpaid $50. They're not going to give you $150 because of interest. They're going to give you the exact same money back, interest free. So that's what that breakdown means. When the new tax code went into effect last year, it may have dramatically altered your tax liability. If you didn't quite hit the tax withholding sweet spot last year, you will want to tweak your withholding this year to make your estimated tax payments more accurate. Now we're going to talk about changing your withholding through your W-4. Oops, that should be W-4. To change how much is withheld from every paycheck, you will need to change your W-4 form, which your employer can provide. The W-4 form changed dramatically in 2018, and the 2019 form also reflects changes to the tax code. You can file a new W-4 form with your employer at any time. The W-4 uses two factors to determine your appropriate holding rate: your marital status and the number of allowances you claim. In theory, you can claim as many allowances as you like, and each one reduces the amount your employer will withhold from your paycheck. You may remember from last year that the TCJA, which is the Tax Cuts Jobs Act, the TCJA suspended the personal exemption and nearly doubled both the standard deduction and the child tax credit. But in case you need a reminder, the personal exemption was worth a separate $4,050 in deductions for the taxpayer, spouse, and each qualifying dependent. But as of last year, it no longer exists. The personal exemption no longer exists. The standard deduction is now $12,200 for single taxpayers, $24,400 for joint filers, which has made up for the loss of the personal exemption for many people. Finally, the child tax credit doubled to $2,000 per dependent child, and became partially refundable. Now let's talk about updating that W-4. If you received a large refund last year, you may want to increase the number of allowances in your W-4 this year. If last April 15th came with a surprisingly large tax bill, decreasing the number of allowances in your W-4 will lead to a greater withholding. Here is a pro tip. Your tax liability is a moving target, and your withholding should move with it so you can avoid surprises at tax time. This is understanding your new W-4. This form can have a big impact on your cash flow as well as your end of the year tax bill. The W-4 changed dramatically in 2018 as a consequence of the Tax Cuts and Jobs Act. It has been updated again for 2019 with some minor changes. Understand how each section of the W-4 can affect your finances. Employees withholding allowance certificate. Understand your new W-4. Employees withholding allowance certificate. Employees withholding allowance certificate. This is the section you must submit to your employer. It includes your personal information and your signature certifying that the information is accurate. Lines 5 and 6 determine the amount of money withheld from each paycheck. So here is a up close look of what they're talking about. This is the W-4. And there is line 5 and 6. Total number of allowances you're claiming from applicable worksheet on the following page. Additional amount, if any, you want withheld from each paycheck. Personal allowances worksheet. Read each allowance statement in this section carefully and enter only those that apply to your situation on line H. Note that there is no longer an additional allowance for your spouse as a dependent, and only one place to mark allowances for dependent children. Remember, the higher your total number of allowances, the less money will be taken out of each paycheck you receive. Now let's talk about deductions, adjustments, and additional income worksheets. Use this section if you plan to itemize your deductions on your tax return instead of simply claiming the standard deduction. Now let's talk about two earners and multiple jobs worksheets. This worksheet will help you calculate your withholding. If your spouse also earns wages at a job, or if you're single and work 2 or more jobs, it's meant to prevent you from having too little withheld and ending up with a large tax bill. At a first glance, this section looks intimidating. Fortunately, when you take it one step at a time, the process is actually reasonably straightforward. So here's the personal allowances worksheet that they're talking about here. And here is for the multiple earners. multiple jobs and 2 earners worksheet. This is what that one looks like for the W-4. All right, now I'm going to do a quick breakdown of taxes state by state. That seems interesting. And now, taxes state by state. That's on page 86 of this magazine. This is what it looks like here. This is the breakdown. This one I might not be able to read. It looks like there's a breakdown literally of every state, but not in a list form. So I don't know if there's a list. We'll see. No, there's not. There's just that map. Some cities and towns charge a local sales tax, and when that is the case, we've shown sales tax as a range that includes state and any local taxes. You know, yesterday when I was talking about what the sales tax was, I said that it seems like it was 8%. But when I looked it up, it said taxes in Texas are 6%. I'm thinking, well, where did I get this 8% from? I might be thinking of the local sales tax that was added on to that. And I'm pretty sure that's right. Because I remember if I buy something that's $1, it's more like $1.08. If I buy something that's $2, it's more like $2.16. So I'm probably paying that local tax in addition. So let me see if I can go through all 50 of these states, and we'll see how everybody stacks up. In Washington State, the income tax is not applicable. The estate tax is 20%. Sales tax is 6.5 to 10.5%. In Oregon, the income tax is 5.5 to 9.9%. The estate tax is 16%. There is no sales tax in Oregon. In Nevada, there is no income tax. There is no estate tax, but the sales tax is 6.85% up to 8.27%. In California, the income tax is 1 to 13%, and the estate tax is non-existent. The sales tax is 7.25 up to 9.75%. Laverne Dorsey says, show Michigan again, please. Yes, I will. So according to this map, it says Michigan is has an income tax of 4.25%. There is no estate tax, and the sales tax is 6%. Hold on. There we go. So for Arizona, the income tax is 2.59% up to 4.54. The estate tax is non-existent, and sales tax is 5.6 to 11%. In Utah, the income tax is 4.95%. There's no estate tax, and the sales tax is 6 to 9%. In Idaho, the income tax is between 1.125 and 6.9%. There's no estate tax, and the sales tax is between 6 and 9%. In Montana, the income tax is between 1% and 6.9%. There is no estate tax. There is no sales tax. Man, that's awesome. I would love to go shopping in Montana. No sales tax? What? I think that's the first time I've read that. Oh no, Oregon also has none. In Wyoming, the income tax, there's no income tax. There's no estate tax, and the sales tax is between 4% and 6%. In Colorado, the income tax is 4.63%. There's no estate tax, and the sales tax is between 2.9 and 11.2%. In New Mexico, the income tax is between 1.7 and 4.9%. There is no estate tax, and the sales tax is between 5.12 and 9.25%. In North Dakota, the income tax is between 1.1% and 2.9%. North Dakota does not have an estate tax, and their sales tax is between 5 and 8.5%. South Dakota does not have an income tax, does not have an estate tax, and they have a sales tax of 4.5% up to 9%. Nebraska has an income tax of 2.46 and 6.84%. They do not have an estate tax, and their sales tax is 5.5 up to 7%. In Kansas, they have an income tax of 3.1 up to 5%, 5.7%. Kansas does not have an estate tax, and their sales tax is between 6.5 and 10.5%. Oklahoma, their income tax is 0.5 up to 5%. They don't have an estate tax, and the sales tax in Oklahoma is 4.5 all the way up to 11%. Here in Texas, there is no income tax. There is no estate tax, but the sales tax is 6.25 up to 8.25%. I knew I saw that 8.25 somewhere. In Wisconsin, oh no, wait, I'm missing Minnesota. In Minnesota, their income tax is 5.35% up to 9.5. The estate tax is between 0 and 16. The sales tax is between 6.8 and 8.8%. In Iowa, the income tax is between 0.33 and 8.5. Iowa does not have an estate tax. Their sales tax is between 6 and 7. Missouri has an income tax between 1.5 and 5.4. They do not have an estate tax, and their sales tax is between 4.23 and 9.74. In Arkansas, the income tax is between 0.9 and 6.9%. There is no estate tax in Arkansas, and their sales tax is between 6.5 and 11.6. In Louisiana, their income tax is between 2% and 6%. There is no estate tax in Louisiana, and the sales tax is between 4.45 and 11.45. In Wisconsin, the income tax is between 4 and 7.65. There's no estate tax. The sales tax is between 5 and 6.5, or excuse me, between 5% and 6.75. In Illinois, the income tax is 4.95. The estate tax is between 0 and 16. The sales tax is 6.5 up to 11%. In Kentucky, we've got an income tax of 5%, no estate tax, and a straight sales tax of 6%. In Tennessee, we've got no income tax, no estate tax, and they pay a sales tax of 7 up to 9.75%. Mississippi, income tax is 3 to 5%, no estate tax, sales tax is between 7 and 8%. Alabama, the income tax is between 2 and 5%. There is no estate tax in Alabama, and the sales tax is between 4 and 11%. Indiana, the income tax is 3.23%. There's no estate tax, and the sales tax is 7%. In Michigan, the income tax is 4.25. There is no estate tax, and the sales tax is 6%. In Alaska, the income tax, there's no income tax, there's no estate tax, and the sales tax is 7.5%. In some places it's 0, and all the way up to 7.5%. In Georgia, the income tax is between 1 and 5.7%. There's no estate tax in Georgia, and the sales tax is between 4 and 9%. In Florida, there's no income tax, there's no estate tax, and the sales tax is between 6 and 8.5%. South Carolina, the income tax is only 1.1 to 7%. There's no estate tax, and the sales tax is between 6 and 9. North Carolina, their income tax is 5.25. They do not have an estate tax in North Carolina, and the sales tax is between 4.7 and 7.5%. In Virginia, the income tax is between 2 and 5.75%. They do not have an estate tax. Their sales tax is 5.3 all the way up to 6%. In West Virginia, the income tax is between 3 and 6.5%. West Virginia does not have an estate tax, and their sales tax is between 6 and 7%. In Pennsylvania, their income tax is 3.07%. They do not have an estate tax, and their sales tax is between 6 and 8. New York, their income tax is 4 to 8.82%. Their estate taxes is all the way up to 16%, and you will pay a sales tax between 4 and 8.875%. In Vermont, their income tax is 3.35 up to 8.75%. Their estate tax is from 0 to 16. Their sales tax is between 6 and 7. In New Hampshire, there is no income tax, no estate tax, no sales tax in New Hampshire. In Maine, that's where my YouTube friend Cotton Cooking Homestead is from. Her income tax is between 5.8 and 7.15%. The estate tax there is between 0 and 12%, and the sales tax is 5.5. In Massachusetts, the income tax is 5.05%. The estate tax is between 0 and 16. The sales tax is 6.25. Rhode Island, which is the smallest state in the United States, isn't it? Their income tax is 3.75 up to 5.99. Their estate tax is between 0 and 16. Their sales tax is 7%. In Connecticut, their income tax is between 3 and 6.9%. The estate tax is between 0 and 12%. Their sales tax is 6.35%. In New Jersey, their income tax is 1.4 all the way up to 10.75%. There is no estate tax in New Jersey. The sales tax is between 6.6 and 9.9%. In Delaware, the income tax is 2.2 up to 6.6. There's no estate tax in Delaware, and there's no sales tax in Delaware. In Maryland, the income tax is between 2 and 5.7%. The estate tax is between 0 and 16. The sales tax is 6%. In DC, the income tax is between 4 and 8.9. The estate tax is between 0 and 16. The sales tax is 6%. I feel like I've missed somebody. Yes, Hawaii. And in Hawaii, the income tax is between 1.4 and 11%. The estate tax is between 0 and 20%. And the sales tax is between 4 and 4.5%. And that, ladies and gentlemen, is all of the 50 contiguous United States plus Alaska and Hawaii. I didn't see Puerto Rico on here, so I don't know how that goes. I know Puerto Rico is it's not a part of the United States, but it is a, what do you call it? What do you call it? I know what it is, but I can't think of the name. Puerto Ricans are citizens of the United States, and they can move freely between the island and the mainland, but it is not a state. Puerto Rico does not have a vote in the United States Congress, which governs the territory with full jurisdiction under the Puerto Rico Federal Relations of 1950. Okay. I figured, I had a feeling about that, but I thought it was called something else. It's not a state, but it's a territory. Yeah, I think it's something like that. So yes, that is taxes state by state. All right, I'm at the 1 hour and 18-minute mark. I'm going to read for about 40 more minutes and wrap it up, and then I'll be back tomorrow with some more tax information from this magazine. How about updating your W-4 after a life change? In yesterday's video, I was talking about a life change or 2 life changes that's happening for my son, who recently became married and has a child on the way. So these are some life changes that need to be taken into account for his W-4s. So let's talk about updating your W-4 after a life change. And now, updating your W-4 after a life change. Life-changing events can also change your tax liability. While you may have other things on your mind after marriage or the birth of a child, a quick check of your W-4 can help you avoid an unwelcome surprise when you calculate your taxes. Your W-4 form tells your employer how much money to withhold from your paycheck each pay period. Ideally, that amount will be about the same as what you would actually owe in taxes. If you pay too little, you will owe the government money at tax time. If you pay too much, you'll get a refund check at tax time. And again, that option sounds good until you consider that you've loaned your money interest-free to the IRS. If you fill out your W-4 properly, your withholding should remain close to what you owe in taxes, unless something happens during the year that changes your situation. Marriages, divorces, births, deaths, and changes of employment status all warrant another look at your W-4 because they typically will change the amount of taxes that you owe. So this is how you make those calculations. Your employer determines how much to withhold based on your marital status and how many allowances you claim on your W-4. The more allowances you claim, the less money that your employer will withhold from your paycheck. You can also provide a specific additional amount for your employer to withhold from each paycheck to get the yearly amount closer to your actual tax liability. Revisiting your W-4 form after a major life event helps to ensure you've calculated your withholding properly. The IRS offers a worksheet with the W-4 form that walks you through the steps to fill the form out accurately. The IRS also has a free withholding calculator on its website at irs.gov/individuals/IRS withholding calculator. So I will also put that in the description and in the live chat. So you can either come back to the video and watch the live chat and replay to get this, or in the description, irs.gov/individuals individuals/withholding calculator. All right, so this right here is the link to your withholding calculator, so that as you're updating those life changes, you can know how much you need to withhold to stay accurate. You don't want to owe too much, you don't want to get too much back. Follow this link to the withholdings calculator from the irs.gov website. All right, that is now a part of the description. So if you come back, you can either look at it in the description or in the live chat replay. All right, how do you make these calculations? Here are 3 common scenarios that might require changes to your W-4. Marriage status. Married couples who file jointly typically have a lower tax rate and more generous deductions than single taxpayers do. If you get married or divorced, you'll want to review your allowances to make sure they account for any tax consequences of changing your filing status from single to married, or vice versa. Children. A new child means a new dependent on your tax return, which means you'll probably want to add another allowance on your W-4. You should also consider potential benefits from other related tax credits when recalculating your withholding. Changing in employment status. You will fill out a W-4 for each employer that you have. When doing so, you'll need to adjust your withholding to account for anything that increases or reduces your total annual income, including a second job, income from self-employment, or a period of unemployment. Here's a pro tip. A tax refund is nice, but it may be a sign that you're withholding too much. Consider adjusting your W-4 to more closely match your tax bill. Here's my little commentary on that. Tax preparation places when it's tax time, like right now, tax filing time, they're always really pushing. We can get you up to $10,000. We can advance you $10,000 in your refund. We can get you the highest refund, things like that. And it's like they're really pushing the fact that, hey, choose us, use our services. We will get you the biggest refund. But I don't really see any tax places saying, come to us. We will make sure you don't owe anything. Like, we'll make sure that you're just where you need to be. Nobody is really promoting the fact of, hey, let us help you prepare your W-4s. Let us help you adjust your withholdings. Let us calculate what you owe so that you don't pay too much or too little. You know what I'm saying? It's always about, they hang that dollar sign in front of you. Oh, come get this money. Come get this money. We can help you get your biggest refund. And it's saying right here, if you get a refund, that means you've just loaned the government money interest free. What could you have done possibly with that money throughout the year if you would have kept it in your pocket? You could have invested it yourself. So anyways, I just think that's an interesting observation, that tax preparation places really focus on how much refund they can get you, top dollar refund, but they never really promote the fact like, hey, you probably shouldn't be paying as much as you should in your taxes. Come let us look over your taxes and we will help you with your withholdings. Like, that doesn't sound sexy enough for them, so that's probably why they don't talk about it. Refunds sound a lot sexier, right? Okay, so let's move on to bunching. This is still talking about deductions. Bunching. I don't know what that means. Get strategic about bunching. That sounds so funny to me. What in the world is bunching deductions? Bunching deductions. Let's find out together, shall we? The Tax Cuts and Jobs Act of 2017 roughly doubled the standard deduction, leading large numbers of taxpayers to abandon itemized deductions and instead opt for the standard deduction. However, it's still possible to exceed the new standard deduction threshold, especially if you practice bunching your deductions. How bunching works. With the new 2019 standard deduction of $12,200 or $24,400 for married couples, it's harder than ever to exceed the standard deduction threshold. Meanwhile, the TCJA, Tax Cuts and Jobs Act, also places a $10,000 cap on the amount that taxpayers can deduct for state and local taxes, severely restricting one of the biggest deductions people made under the old tax code, especially taxpayers from high tax states. Bunching deductions offers a way to close the gap between itemized expenses and the standard deduction by consolidating deductions you would otherwise make over multiple years into a single tax year. This approach also decreases your expenses in years you take the standard deduction, increasing the financial benefit. In essence, you maximize the efficiency of your deductions over time by reducing the deductible expenses in years you take the standard deduction and increasing them in years you want to itemize. For example, suppose a single taxpayer itemized $10,000 worth of deductions in 2018, including roughly $5,000 in mortgage interest, $3,500 in state and local tax deductions, and another $1,500 in charitable contributions. By bunching 3 years or $4,500 worth of charitable deductions into 2019, the taxpayer is able to clear the current standard deduction by $1,000 for the current year and reduce the load of potential deductions to $8,500 in each of the next 2 years. Bunching preserves the tax benefits of the charitable contributions in this example. Even though I read that, I still have no idea what bunching means. Hopefully, you'll get an opportunity to go back to the replay and hear me read this over and over again, because that's what it's going to take me to understand this. I'm going to have to read this article again and again and again to really understand what bunching means. Here's a pro tip. If you need to lower your tax liability, consider bunching charitable donations over multiple years in one tax year. Oh, that was an easy way to understand it. Charitable donations. So instead of taking donations from this year, and this year, and putting it on each individual tax year, you bunch them together. Okay, that makes sense. I didn't know I could do that. Okay. Know your deductions. Finding enough expenses to consolidate through bunching takes some strategic planning. You need to have enough cash available to pay expenses in a lump sum during years you intend to itemize, and a few expense categories offer dependable opportunities for consolidation. For the majority of taxpayers, itemized expenses come from 4 categories: state tax, local tax, medical expenses, and charitable contributions. Now let's talk about some mortgage interest and state and local taxes. Consolidating multiple years of mortgage interest payments can be challenging, since most mortgage lenders don't allow early interest payments. Federal rules limiting state and local tax deductions to $10,000 also limit strategies for bunching property taxes. Since you can't deduct payments for taxes that haven't been assessed, you can only prepay them if you have quarterly payments that allow you to make a January's payment in December. Or you can make your December payment late so that it's grouped in with the next year's payments. Be careful with this strategy. Be sure you still come out ahead after factoring in the penalties and interest. Now, medical expenses. Some big ticket medical expenses, such as payments to an orthodontist for a child's braces, or late year purchases of medical supplies used over the course of a year, offer potential avenues for bunching. But those expenses have to exceed 10% of your adjusted gross income in order to qualify. And now let's talk about charitable donations or charitable contributions. Charitable contributions offer an excellent opportunity for taxpayers interested in bunching their deductions. In general, as long as you keep your annual cash donations to public charities under 50% of your AGI, the IRS will let you deduct them. In addition, the new tax law still allows donations of up to 30% of AGI in appreciated securities, a strategy that frequently offers additional tax benefits by limiting taxes on capital gains. In most cases, those options should leave a lot of room to boost your itemized deductions over the standard deduction for a given year. You can also boost your deductions by choosing to itemize in a year you plan to make a bigger charitable contribution than usual. For example, donating a used vehicle or giving more to your college alumni fund during a reunion year. Now, taking advantage of donor-advised funds. Donor-advised funds act as a holding account for charitable contributions, making them a flexible solution for taxpayers seeking to bunch their deductions. Your charitable contribution becomes deductible from your taxes when the money goes into the fund, even if you don't direct the money from the fund to a charity right away. In other words, with a donor-advised fund, you can take a charitable deduction in any year that you GI. You may be able to bunch some costs, such as child's braces. So that was bunching. All right, ladies and gentlemen, I have just read Understanding Tax Credits and Deductions, Filing Your Own Taxes or Hire a Professional, Hitting the Tax Withholding Sweet Spot, Your New W-4, Updating Your W-4 After a Life Change, Taxes State by State, and Getting Strategic About Bunching. So I'll be picking this up tomorrow to read a little bit more. There's quite a bit more left. I'll share the magazine table of contents so you can see everything that has been covered today and tomorrow. And actually, when I get done with this live stream, I'm going to put it in the description, the titles that I've read. Make sure you go back to the live chat replay so you can see when I'm reading it. You can skip ahead and find out exactly what I'm reading and where. But this is what has been covered so far. Those with a check mark is what was covered yesterday, and those circled in a bubble, that's what was covered today. I really do appreciate you guys taking the time, since we've all got so much free time lately, to learn something new, to get your finance and business mind together so that you can prepare for your filing of your taxes if you have not done so already. Also, another quick reminder, it is time to do the census. I think it's actually due today, so like I need to get this done like right away. What am I trying to show? Hold on. It's so hard to do this in reverse. It is 2020 census time here in the United States. As it says here, your response is required by law. Su respuesta es requerida por ley. Requerida por ley. So yes, if you got this in the mail and it's still sitting on your kitchen table or your counter, pick it up, fill it out, and it also says it's available online at my2020census.gov. In the other video that I made the other day, I made top 40 things to do while you are hashtag at home and hashtag have free time. This is one of those things you need to be doing. So yeah. And matter of fact, I will also put the link here so you can see my2020census.gov so we can all be responsible citizens. Don't forget to complete your census. You can file online my2020 census.gov. Hopefully that will pop up as a link that you can use. And it didn't. So I might have to do a copy and paste. I don't know why. Sometimes it does, sometimes it doesn't. My 2020 census.gov. It's really weird because yeah, it's really weird because I typed in the exact same thing and that link didn't work, but then I typed it in on the website here and it did work. So I don't know what's up with that. Maybe I misspelled something. I'm gonna copy and paste so you can get a chance to fill out that census if you haven't done so already. Let's try that again. Okay. Oh, I missed the HTTPS, all that good stuff. So that is the link to do your census online. Check it out. I'll put it in the description as well. Follow this link to do your census 2020 census survey online. All right. Wow. This live stream is chock full of links and resources that I hope is valuable to you guys and gals. Thank you again for your time. We are coming a little bit short of 2 hours, but I'm going to give my voice a rest today as I did my Bible reading not too long ago. And I just realized that is the wrong heading. That is the wrong title at the top. That's funny. Well, I'll take that off now. This is not the Bible reading. This is the tax reading. This is what should be up there right here. See that? A little bit too late now because I'm getting ready to go off. But yeah, this is the tax reading live stream, not the Bible live stream. But nobody noticed that at the top, so oh well. I'll see you guys tomorrow, either tomorrow morning for my Bible readings, which are at 7 a.m. Central Standard Time, or for tomorrow afternoon for a little bit more of the tax reading. So thank you for your support. Hope you learned something. If so, thumbs up, share it with somebody that could find it helpful, and I will see you next time.
Thanks for watching, and don't forget to follow me on social media. Now, let me know what you think about this next upcoming video.